Hello and welcome back to my channel. Today we are going to look at IFRS 13 fair value measurement. As usual, the first slide of this video will have a mind map and the last slide will have an overall summary of IFRS 13 fair value measurement. Below the like and subscribe button, I'll provide a link to a PDF file that has got the summary of IFRS 13 used in this lecture. You can download it and review IFRS 13 at your convenience. Now let's dive right in. I'll start by providing a quick 1-minute summary of IFRS 13 and then move on to provide more details about the standard. IFRS 13 has got three main objectives: to provide or offer a definition for fair value, and then provide a framework for fair value measurement, and then finally share all the disclosure requirements. Apart from providing definition, IFRS 13 also provides some guidance for fair value measurement. When it comes to framework or hierarchy, IFRS 13 splits fair value measurements into three categories based on the inputs used. When there is a quoted market price in an active market for an identical asset, then it's level 1. When there is a quoted price but it does not fall under level 1, then it's level 2. Also, when there are observable inputs, it is still level 2. When there are no observable inputs, then fair value categorization falls under level 3. The standard also offers some widely used valuation techniques, and finally a lot of disclosure requirements. The whole objective behind the disclosure requirement is to enable the readers understand the valuation techniques used and the inputs method used in the valuation. Now let's move on to understand IFRS 13 in a little bit more detailed manner. So when does IFRS 13 really apply? IFRS 13 is applicable when another IFRS requires or permits fair value measurement. So what really is fair value? Fair value is a price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. It is a price that would be received to sell an asset or an amount paid to transfer a liability. It has to be an orderly transactions, i.e., it is not a fire sale. And then it is on measurement date. So if there are any market conditions that are adverse on a measurement date, for example, like a COVID-19 pandemic, then fair value should consider the decline in market value because it is on that measurement date. Moving on, the standard provides guidance. An entity has to determine a particular asset or a particular liability that has to go through this fair value measurement exercise. And then it has to determine what is the principal market, i.e., which will be the most advantageous market if an entity has to sell an asset or settle liability. And then finally, it should use an appropriate valuation techniques. The guidance goes on further to explain a little more details. It says an entity should think like a market participant and should consider everything a market participant would consider in an ordinary sale or settlement of a liability. And the expectation or the assumption is the liability will stay as is. That is, there is no settlement, no cancellation, or no extinguishment of a liability on the measurement date. Now we move on into crux of the standard, the framework offered by IFRS 13 for fair value measurement. IFRS 13 categorizes fair value into three categories. Level 1 is where there is a quoted price in an active market for an identical asset or liability. The best example here is a listed equity share, where a quoted price is generally available in an active market and for an identical asset, that is another share of the same entity. And this is for actively traded public shares because that's where we actually have an active market. Next is level 2. Level 2 is where there are observable inputs. This could be interest rates, yield curves, implied volatility, or credit spreads. A simple example here would be fair value measurement for an interest rate swap. Assets categorized under level 2 could also be based on quoted market prices that do not fall under level 1. Example, when there are quoted prices for similar assets in an active market or for identical assets in an inactive active market. They'll fall under level 2. And finally, level 3. Level 3 is where there are no observable inputs. When there are unobservable inputs, the assets or liabilities are categorized as level 3. This is generally based on the best information available within the entity's knowledge or based on market participants' assumption. Most or all of private equity investment valuations generally fall under level 3. We now move on into valuation techniques. The standards start by saying an entity should use an appropriate valuation technique depending on the circumstances and information available. The objective should be to maximize the use of relevant observable inputs and minimize the use of unobservable inputs. An entity may use single or multiple methods of valuation. The standard cites three widely used valuation techniques. The first one is market approach. This is where the market prices or relevant information generated by market transactions are used to determine the value of an asset. The next one is cost approach. This is where fair value reflects the amount that will be required to replace the service capacity of an asset. This is, in simple terms, this is the replacement cost. And finally, income approach. This is where future cash flows or income or cost are discounted into a single value that represents the current market expectations. We now move on to a very important part of IFRS 13, disclosures. When it comes to disclosures, the objective is to let the users of financial statements assess what valuation techniques and input methods are used to develop these fair value measurements. For level 3 assets, where significant unobservable inputs are used in fair value measurements, we want to let the users know what is the impact of these fair value measurements in profit or loss or in other comprehensive income. When it comes to disclosure of fair value measurements, an entity should determine the appropriate classes for classifying assets and liabilities across different fair value hierarchy. To start with, when it comes to non-financial assets, the expectation is an entity will always use it for the highest and best use. And when an entity does not do that, then it should explain what is the reason for its current use and why it's different from the highest and best use. We now move on to the minimum disclosure requirements for fair value measurements. The amount of disclosure goes up as we go down to level 2 and level 3. For all level 1, 2 and 3, the first 4 minimum disclosures are required. What is the fair value measurement? If it's on a non-recurring basis, what is the reason? What is the level of fair value hierarchy? And if there are any transfers between level 1, 2 and 3, what are the reasons for transfer? Moving on to level 2 and level 3 assets, entity has to further disclose what are the valuation techniques, inputs used in these valuations, and if there are any changes in the valuation techniques, explain why there are changes. When it comes to level 3 assets, the amount of disclosures goes up. An entity has to provide reconciliation between the opening balance and the closing balance, and it has to explain if there are any unrealized gains or losses and realized gains or losses where the amounts are captured within the profit and loss or other comprehensive income, including the line item under which they are disclosed. An entity should also provide sensitivity analysis. What would be the impact to the fair value if the amounts used in the inputs change, or if one or two of the inputs used in the valuation techniques changes. And finally, an entity is also required to provide quantitative information about unobservable inputs, though there are few exemptions to this last rule. That is it. We have come to the end of IFRS 13, fair value measurement. We looked at the definition, guidelines given in the standard, and then we moved on to the framework where the standard categorizes assets or liabilities measured at fair value into level 1, 2 or 3 depending on the inputs used in the valuation technique. We also looked at the most widely used valuation techniques, and finally we looked at what are all the disclosure requirements. Feel free to go ahead and download the PDF file and refresh IFRS 13 at your convenience. Thanks for watching.